I'll be taking the lead today, which is pretty exciting for today's podcast. Jim's going to sit in the background. He's going to take care of all the presentation pieces. But we've got an interesting podcast for us today. Again, one of the biggest things about our podcast is about education. And the group of people that we're going to interview today are advocates about understanding something that we're all going to face at some point in our life. And that's really about tax fairness for single seniors. So I'll go through and introduce everybody. First, obviously, I'm going to introduce the main character. The character that I call my partner in crime is Jim. Jim, welcome.
Oh, thanks. I thought it was going to be Denis, but hey, I'm flattered.
He keeps that to this. So obviously, the second person is Denis. Denis is our portfolio manager. Also, he has a stake in this because he is also an expert when it comes to trust and estate practitioners. So, Denis, welcome to the podcast.
Thank you, Ryan. Glad to be here again.
Yes, we're always glad to have your smiling face here. And then finally, I'll introduce the three people that we met a few weeks back that represent SSTF, which is Single Seniors for Tax Fairness. And I'll go through and introduce. So first off is Elizabeth. Elizabeth, hello, and thank you for joining us on our podcast.
Thanks very much for inviting us.
And then second, we have Isabel. Isabel, welcome to our podcast.
Hi, glad to make it.
Yes, absolutely. And of course, last but not least, saving the best for last, Jean. Jean, welcome to our podcast.
Thank you for having us.
Oh, it's my pleasure. So today is really about again, Elizabeth and I chatted weeks ago, brought awareness to something that I didn't know about, but when you really think about it, as I said before, it really does affect all of us at some point in time. And it's important for all of our listeners to know the effect that it's going to have. And obviously, with things going on in the world of elections right now, it's important to reach out to your MP, especially after listening to the information that we're going to provide and the group that we're talking to today. They're really experts and advocates of making sure that as a single senior, that we uncover the disparities that are really happening within our tax system. So with that, I think I'd like to obviously open up the discussion. I guess I'll start with you, Elizabeth, as you're the first person that I touched base with. Can you just kind of walk through kind of an overview? What is Single Seniors for Tax Fairness and kind of your mission?
Well, thanks, Ryan. Single Seniors for Tax Fairness, we're a Canadian nationwide movement, and we're devoted to lobbying for revisions to the Income Tax Act to provide fairness and equity for single seniors. And we'll later on in the podcast give you some examples as to where those disparities exist. And how we define single seniors are those folks who are 65 plus in age, who've never been married, who are widowed, separated, or divorced. We're entirely volunteer run, funded by donations. We are actively lobbying members of the federal government to get changes to these rules and these laws. We have 1,000 plus supporters, and we get more every day. We're hear from seniors all over the country in terms of how unfair the current tax system is. We've met with over 140 MPs from across parties. We've had 9 petitions read in the House of Commons by supportive MPs from 4 of the 5 major parties. And we've made recommendations in pre-budget submissions to the Finance Committee. So we're quite an active group, and Jean and Isabel are integral to that.
Yeah. And I think an important thing that you guys said to us more recently too, which is often when you perform or send a bill, it's taking away from somebody else. And that was something that you guys wanted to make clear, is that you're not asking for anybody else to have things taken away. It's just simply looking at the current tax act and saying, hey, there's a disparity, especially when seniors, when you become to that point, when you will become a single senior at some point, that we're wanting to make sure that there's fairness along the way. Is that correct?
Yeah, that's right, Ryan. I mean, we're certainly not advocating for any changes to any benefits that senior couples receive. Yeah. We're fighting for greater equality for single seniors. And, certainly what we find with senior couples is that one member of that couple will be single at some point in that relationship, largely through death of spouse. So this is something that could affect, you know, will affect many seniors across Canada.
Yeah. So with our current system right now, there obviously are some tax inequalities. Um, is there anything else in specific that we're looking at? Obviously, as you just mentioned, like, somebody becomes single, pension income splitting is obviously one of those things that takes place.
Yes.
What are some other examples of things that our current state that really puts singles at a disadvantage?
So yes, you're right. Pension income splitting, and for those of you who are listening, who may not be familiar, that's where you have the higher earning member of a senior couple. They can allocate up to 50% of certain eligible pension earnings to a lower income spouse. So what that does is a few things. That lowers the tax bill that senior couple will pay. And it also helps them drop below clawback levels for things like old age security and another little credit that doesn't get discussed very often, which is the non-refundable age amount tax credit. And of course, a single person cannot split income. And the second area in terms of taxation is the use of credits. So there's 3 credits in particular we're focusing on right now that all seniors are eligible for, which is the personal amount, pension amount, and the non-refundable age amount. And each member of a couple can claim those 3 credits. And so a couple can claim 6, where of course a single person can only claim 3. And so that means that couples get significant advantages from being able to claim those credits. And not only that, but when it comes to the age amount and the pension amount, if one particular spouse doesn't use up all those credits, they can pass them over to the remaining spouse. So they're really able to take advantage of that. And another area, the last area that we're focused on, is the RRSPs and RIF assets. So in the case of a couple, when one member of that couple dies, they can transfer those assets to the remaining spouse tax-free, which of course a single person can't do. In the case of a single person, when that person dies, then the estate would sell off those assets and then they could be taxed as high as 50%. So that's a significant tax hit in the year that single person dies. So we are concerned about that. And we're looking for remedies for that as well.
Yeah. And I think there's a lot of real life scenarios of people that are out there that are already facing this. I don't know what the number, and I'm pretty sure, Isabel, you sent some information beforehand, so I don't know it offhand, but the number of people over the age of 65 is growing every day. So it's obviously becoming more and more of an issue and an opportunity for us to really have these conversations to make sure that people, if they haven't realized yet, or if they have parents or family members that are approaching the age of 65 that become single, that this is a great opportunity. I know we normally share the the address later on in the show too, but I think it's fair to just say hello. What is the website that you guys have that people can start finding some of this information or potentially become an advocate with you guys?
Well, we do have a website. Our website is Single Seniors for taxfairness.com. So www.singleseniors4taxfairness.com. On that, you can see a list of resources. You can see the submissions that we have prepared. You can see news articles that have been written about us. You can see stories that we have received from other seniors across the country. And maybe folks will find things that they in turn can relate to. We're also on Facebook under Single Seniors, Blue Sky, and LinkedIn. And we're certainly wanting people to, visit our site. And on the site, you can also sign up for our email list, which will make you add you to our supporter list. So we'll send you regular updates. There's no fee required, but you'll get regular updates. So we do try to stay in contact with as many of our supporters certainly as possible. And again, we see our numbers are growing.
Yeah.
You can also go to our website to donate if you'd wish. We are entirely volunteer driven. So there's an opportunity to donate. If you'd like to write to your MP, we have a template that you can use as a letter to forward to your MP. And we do get, again, contacts from folks all the time who are saying, I've written to my MP And oftentimes, if that's the case, if they let us know, we follow up with that MP and say, you've had a constituent write to you, and that gives us an opening for actually a meeting with that MP and sometimes with the supporter as well. So it's a really good opportunity to reach out to MPs and express your concern.
Yeah. So moving to the next part, which is really about solutions. What are the recommendations that SSTF has proposed going forward?
Well, maybe before we get into the recommendations, I think to simplify for people that are out there, and we'll maybe set the RSP discussion aside for 1 second. But the bottom line is, and the reality of it is, if you are a married couple in retirement, and I'll leave this open to any one of you three, what you're saying is a married couple at the end of the day has a higher net after tax income than a single senior if they are generating the similar level of income. Is that correct? Is that what we're saying here?
Yes, that's correct. And Jean and Isabel, I don't know if you want to weigh in on anything we've discussed so far or Jim's comment.
Well, what we're basically saying is that a couple with the same household income as a single senior. So a single senior with $50,000 in income compared to a couple with $50,000 in income. They both have $50,000 in income to spend on their expenses. However, because of income splitting and because the income splitting lowers the net income for the couple, they, number one, pay less tax, and number two, they are less subject to the clawback of OAS and the pension income amount. So the pension income splitting does two things: reduces the amount of tax the couple pays and makes them less likely to pay back, have their OAS clawed back and their pension income amount clawed back. So this is a big tax advantage. I believe you're going to put up a chart later, but at the $50,000 level, a single, and this is based on 1922 tax. A single senior would pay $6,521 in taxes, while a couple only paid $1,172 in taxes. So that's over $5,000 difference in after-tax money that the single senior has to pay household expenses and daily expenses. And that's what we are saying. And the other thing that we are pointing out is that whether you live alone or whether you live or whether you live as a couple, you have the same non-discretionary expenses. For example, if you live in a home, you have to pay property taxes, you have to pay insurance, you have to pay repairs, rent, you have to pay rent, you have to pay condo fees. Those non-discretionary expenses are not reduced when you're single, and so it's unfair that we have to pay so much more taxes than a couple, and yet we have the same non-discretionary expenses.
I'm wondering, Jim, would it be helpful to hold up that chart now?
I'm sharing it right now.
Okay.
So I'm sharing the disparities in taxes
Yes.
payable.
Yeah.
And then I went to case number 1. So that's what I'm sharing at the moment.
Okay, so I think that sort of gives an illustration, and then we'll jump into the recommendations after this, Ryan, because it might help to set the stage for it. So this is the example that Jean was referring to. So we wanted to compare apples and apples. We wanted to compare the taxation of a couple at $50,000 in income with a single person at $50,000 in income. So we were very original in naming our spouses. We called them spouse 1 and spouse 2. So in those first 2 columns, and then the last column is the single senior. So you can see in that example that everyone in our scenario is getting old age security, everyone's getting CPP, and then we have an example where the couple's getting an additional source of income, approximately $16,000, just a little over, that they're able to split between the two of them. And a single person has an additional $33,000 in income coming from any number of sources. And even though the single person has an additional amount of income at 33, that single person is not getting the additional OAS and CPP that a couple gets. So basically, it's comparing a couple at 50,000 with a single at 50,000. And then if you look down further at the total federal tax payable line just beneath it, you can see that spouse one gets 24,000 in credit, spouse two, 24,000 in credit. So the couple gets combined credits of roughly 48,500. So that's what I was saying earlier, is that each couple can claim those three: the person amount, pension amount, non-refundable age amount. And then if you notice a single person, they're only able to claim 3 credits, but their total credits is only 22,000 to 23,000. And you may think, well, wait a second, a single person is half of a couple. Why doesn't the single person get roughly 24,000 in credits? That's because at 50,000, that single person is already starting to experience a clawback of one of those credits, which is the non-refundable age amount. And so by time it works its way through, at the end of the day, as Jean said, the couple on that 50,000 might be paying roughly, $1,100 in taxes, but a single person is going to be paying roughly $6,500 in taxes. That's a 5.5 time tax differential. And as Jean alluded to, if you look at the expenses and the obligations of a couple versus a single, there's really no difference. And so that's just to point out the inequality there. There's no differences in expenses. So why is there such a significant disparity in the taxes that single people pay versus couples?
So in the non-discretionary, there's no differences, because I would assume that if you're a couple, probably spend more on food because you're feeding 2 people, clothing potentially. Like, is it just the discretionary that you've done the analysis on, or is it total expenses?
Well, I think the answer to those questions is that, first of all, food costs and clothing costs, they're going to vary between couples, never mind between couples and singles. Those are unique family expenditures. And so I think the only conclusion that anyone can draw when you say that is different households spend money on different things.
Right.
Like there's no data, to say, well, that makes a substantial difference in taxes. And I guess the other challenge is those are 2 isolated data points. If you look at all the things that households spend money on, as Jean mentioned, a number of them, if you look at the fact that maybe, single people, when it comes to food, they might like to buy in smaller quantities, but can't, because that's not how items are sold.
Right.
They can't take advantage of some of the discounts available at a large, warehouse retailer that shall remain nameless. They may have other expenses. They may have to drive themselves to the doctor, whereas in a couple, maybe, they can, the spouse can take them. The spouse might be able to look after a couple that has a person that has significant needs, where a single person has to hire a PSW. Like, we've looked at some of the various economic data and statistics, which we can get into, which basically don't support the status quo. So it's really kind of dig deeper and saying, what is the rationale for this discrepancy? And just like I say, different households spend money on different things. That can't be the justification for that kind of discrepancy. We can't base tax policy on perception. We need to have it analyzed from a factual perspective to say what's really going on. And we've got some facts and statistics we can get into a bit later if you want.
And I can speak from personal experience. When my husband passed away, nobody lowered my property taxes. Nobody lowered my water bill. Nobody lowered my heating. So all of those expenses were the same. When I had to put a new roof on my house, nobody gave me a discount because I'm a single senior.
Yeah.
So basically, for those major household expenses that you really have no choice. You have no choice on whether or not to put a roof on your house. You have no choice on whether or not to pay condo fees. Those fees stay the same when you become a single senior, or if you're a lifetime single senior.
Yeah, absolutely. And the reason why we're asking the questions is because I think some people who don't quite understand, I think that's a natural question to ask. Well, doesn't it cost more for 2 people as opposed to a single person? But Elizabeth, you made a great point, right? There are things that when you don't have a spouse to support you, you have to hire others to assist, right?
Yep.
So those are costs that someone wouldn't necessarily think of until they're in the situation.
Yeah.
Right. So I'm glad that you cleared that up for us.
Yep.
Yeah.
Now, which direction? Or sorry, were you going to say something?
Yeah, I was just going to add another example. My mother's going to be 90 soon,
Well,
and she's been a widow since 54. So she's dealt, and I've dealt with this because I do her taxes. And when you're holding, not talking about the RSP, but this time when I'm talking a non-registered account, when you're getting distributions or dividends, if they become too high and you can't split them, you can be cut from different government payouts, which just happened this year to my mother. For the second year in a row that happened to my mother. It's that's the part that I see that could be improved, could be fixed. Because it's not like they're making a lot of money. That's the question, and they're being cut because they can't split income, where otherwise they'd be still getting everything.
right.
And I also think, since we're sort of carrying on with statistics a bit here, but I also think there's a perception that single people only look after themselves.
Right.
If you look, for example, the average age of the sandwich generation, that's women who are looking after younger children as well as, consequently younger grandchildren, and also maybe looking after parents because of increases in life expectancy. The average age of women in the sandwich generation are 60s. So now those women could be married or common law, but they also could be widowed, separated, divorced, never married. They have exactly the same family obligations as single folks, have the same family obligations as couples, and yet they're taxed more. More than 50% of seniors are dipping into their personal savings to help their children and grandchildren. And that was a recent survey I saw last year. And that either could be, that's not helping them out with the odd bag of groceries or a box of diapers. That's helping them out with mortgages and rent. And those seniors, yes, they could be married or common law, but they also could be widowed, separated, divorced, never married. I think we need to get over this myth or perception that singles are just looking after themselves. They're living in their own homes, and they have more than enough money. We don't know. We have no information. 39% of seniors who are renters are living in unaffordable housing. And again, those folks could be married or common law, but they also could be widowed, separated, divorced, never married. And the government really has no valuable statistics. We often hear that, seniors are doing very well. Only 6% of seniors live in poverty. They never finish the sentence, which is that single seniors are 4 times more likely to live in poverty than couples.
Wow.
And another challenge is that metric, the poverty metric, is something called a market basket measure, a statistical measure. And what it basically does is it looks at the cost of a typical basket of food, clothing, shelter, transportation, and other items for a family of 4. That measure was not designed to measure seniors' poverty. And that's not me saying it. That's the Institute for Research on Public Policy. Similarly, the Consumer Price Index, which is used to measure inflation, which is another basket of goods concept, the CPI does not either include things that seniors spend money on or isn't weighted towards the things seniors spend money on. So again, the Consumer Price Index is not an effective measure for measuring the impact of inflation on seniors. And that's not me saying it. That's the Auditor General of Canada in a report they released last year called Programs to Assist Seniors. So we have 2 key economic measures that are not useful for assessing either the levels of seniors' poverty, the kinds of help that seniors need, or the impacts of inflation on seniors. So I think getting back to the broader point is that we do not have accurate data to see whether or not these policies make sense. And, that also, I think basically we don't have policies that reflect Canada in 2025 and all of the obligations that seniors in general, both single and couples, are dealing with.
And just one thing, according to the 2021 census, 39% of those 65 plus are single. So that's almost 40% of the and that's as of the 2021 stats. And with people living longer, this is going to increase. So there are going to be more and more single seniors as time goes on.
Yeah.
Right. Okay. Now, should we get into the RSP discussion at this point?
Yeah, sure. Isabel, you've been standing by, and then we can go back to our recommendations too.
Yeah.
We can finish off with that.
This is something a lot of people don't know about, and it can come as a real shock If you have a single parent and they die, as Elizabeth mentioned, if you have a spousal beneficiary, the RIF value can roll over to the spouse's RIF. So then the spouse would pay would only pay tax as the withdrawals are taken. But when single seniors die, the beneficiary, maybe your child, whomever, would get the value of the RIF, but your estate is fully taxed on that amount of the RIF. It's included in your income in the year of death. It's a huge hit. Plus, if it pushes the income over the maximum OAS clawback threshold, OAS has to be paid back as well. I did an example on myself using my 2023 income tax return. And I'll give you the numbers. My annual income that year was about 70,000. I had about 200,000 in my RIF. If I had died that year, my estate would have paid an extra $85,000 in income tax, and the OAS of about 9,200 would have been clawed back. So there's over $94,000 out of that 200,000, which would markedly reduce the estate for the beneficiary of the estate. So, and right now, there's not a lot of ways to avoid this on a RIF. You can take more than the minimum withdrawals, which means you're paying more tax now versus, the special treatment that couples get. And another thing that hit me too is that for 20 years that we had RRSPs and not RIFs, that was the late 50s to the late 70s, the only option was to buy a payout annuity. You would buy a payout annuity on a single life, joint and loss survivor, with a guaranteed period. You could elect a 15-year guaranteed period. If you died before that 15 years was up, your designated beneficiary got the remaining payments as they fell due. So they would be taxable in the year of receipt. Later, there was another option introduced, a term certain to 90, so that is totally gone at 90, but it spreads it out. Now, the thing about payout annuities, we don't hear much about them these days because interest rates are very low. And payout annuities, it's a single premium and it's based on today's interest rates and a projection of future rates. So they're not a great buy, but they do have that advantage when it comes to the death benefit.
And I know you were asking why they are not being sold. And I kind of want to share why they're not and why they're not really talked about. And I think, Isabel, you just brought up one of the main reasons where up until about 2 years ago, the interest rates were so low that they couldn't even keep up with inflation, right?
Yeah.
So that didn't make sense. Secondly, most people deal with the banks.
Yep.
Banks don't sell annuities.
That's right.
So when you're a customer or a client of the bank and you walk in and you say to them, I have X amount of dollars in my registered account or whatever else, what should I do with it? They will never say to you, you should take it to our competitor, the insurance company, and give it to them.
Yeah.
Right? So part of the reason is people are receiving advice from institutions that don't offer these products.
That's right.
The third reason is, and these are products that Ryan and I and Denis do offer. Whenever we share how the annuity works, most people do not like the fact that you're giving up that money. Is essentially what you're doing. You're giving up control of all that money, right? And that's one of the downsides of the annuities is the fact that you're giving it to the insurance company, and the insurance company is hoping that you pass away at a much younger age, right? And you're hoping you're going to live for as long as you possibly can to squeeze every dollar from it, right?
That was definitely one of the advantages of RIFs is that you keep your capital and you can choose how to invest it. It's up to you if you buy mutual funds, GICs, or whatever. But the problem is, I don't think, when you're buying an RSP, they were pushed to everybody.
Oh, yeah.
Probably some that shouldn't have bought them. Yeah. The trouble is they wouldn't tell you, oh, by the way, if you're single when you die, your estate's going to pay tax on that. Because that's just not part of the selling process.
Well, again, I'm a former banker and I've worked at the branch level, and We had RSP season and we were expected to work until 11, 12 o'clock at night for the deposits. The advice was never, this is what's going to happen down the road to this money, right? So there's a tax explosion is what we refer to it. And you're basically talking about the tax explosion, right? That takes place. It's all about, you need to put, your accountant says you should put in 10,000, put in the 10,000, here's your refund and go on vacation. That's what people are focused on. And that's how they were sold, right?
And what I wondered when I saw how much I would have had to pay in extra tax, I don't have records for this, but I wondered, well, what's the sum of the credits that I got from my RSP donation or contribution all those years? You almost wonder if you're going to get hit more tax at the end than you actually saved.
Well,
Right?
that happens, right? So the bottom line is,
Yeah.
if your contributions and your withdrawals are done at the same tax rate, you're no further ahead or behind in that situation.
Yeah.
If your contributions were made at a higher tax bracket, but you were pulling out a lower tax bracket, then you're winning the game until the tax blow up at death, right?
Yeah.
If you were putting them in at a lower tax bracket and contributing at a lower and pulling out the other way around, you win, right? So so the bottom line, like, we deal with, for example, teachers who have a wonderful pension plan, or any government worker, right? To have wonderful pension plans, and the bankers are still telling them, "Oh, you should max out your RSP." And many of them are approaching 71, and they're looking at us saying, "We're actually at a higher tax bracket in retirement at age 71 than we were during our working years." So I would say that we don't really favor RSPs in all situations. They are appropriate in certain situations. I've had a lot of children of parents who have passed away, single parents who have passed away, who would then come to me and say, "I didn't realize half of this is going to the government now in taxes. And I don't want this to happen to my kids. How do I get out of this?" Right?
Yeah.
Because again, they're not told about that future problem.
Yeah. And I mean, the interest rates, I mean, I worked in insurance, an insurance company for 34 years, and part of that was in the actuarial product development. Historically, you could earn a real rate of return of 2%. You'd earn 2% more on what you're investing than the cost of living. That turned upside down.
After 2008, that turned upside down.
Exactly. I mean, these interest rates are insane. I had a mortgage of 18% in the 80s, the early 80s, and people look at you like, when you say, well, interest rates could go up, and they shake their heads. High interest rate to them is 6%. It's crazy.
Yeah. Well, a lot of seniors, when I was at the bank, this was 35 years ago, they were coming in, cashing in their government of savings bonds that were paying them 11, 12, 14%.
Exactly.
Right. But we're not getting that anymore. We're definitely in a different environment at this point. So now, no one's saying that you shouldn't invest in RSPs. Again, I think you really need to understand fully what it means for you today, the impact of that decision today, but also the impact down the road when you are actually retired. I've had people come to me say, "I didn't realize you got taxed on the income," right? They thought it was tax-free income, right? There's so much misinformation out there. We're trying to do the best that we can to educate them, and so are you as an organization as well. So I'm glad that we're recording this today and sharing a lot of this information with people, because they just really don't fully understand the impact of the RSP at death. All right. So what should we talk about next?
Recommendations.
All right. Lead the way, Ryan. Recommendations.
All right, well, that's it. I know on your website, looking over it, you guys have already proposed some solutions.
Yes.
And started the dialogue with experts, tax consultants, obviously the MP discussion. So tell our people, like, what are some of the proposed solutions that you guys have
Okay, so we've, in our budget submissions that we've made to the federal government finance committee, our first recommendation is that the government introduce a tax provision to compensate single seniors for the considerable reduction in taxes payable by couples who use pension income splitting. And again, we're not advocating that the government remove pension income splitting. We're saying please make it fairer for single people. We don't have a specific dollar amount on that. I think the government would need to do an analysis of what an appropriate fix would be on that, but something needs to be done. Our second recommendation, that the government implement a new single senior non-refundable tax credit equal to half the personal amount for the applicable taxation year. So in the example we discussed, we showed you the impacts of some of the credits and the difference in taxation that can cause for single seniors. Our third recommendation is that the government increase the pension income amount from $2,000 to $3,000 for single seniors, again, getting at the credit side of the challenge. Our fourth recommendation is that we increase the income clawback thresholds for old age security and the age amount non-refundable tax credit. Now, in the example that we discussed, we showed you that at the same level of income, a single person starts seeing a clawback of that age amount, whereas a couple doesn't on the same income because they can split and drop below the clawback level. And that's the same concept with old age security. The current clawback level is around 90,000. So what that means in theory is you could have a couple with a combined income of about $180,000. If they split that income at $180,000, a couple could in theory continue to receive their full old age security. Whereas, single folks start getting their old age security clawed back much sooner because again, they certainly can't split the income. So that's our tax recommendations. And then around the RSP that we just discussed, that we amend the tax treatment for RSPs on the death of a single senior to allow a single senior to roll over those assets to any beneficiary. And I think what that's trying to get at is that household structures and family structures in Canada are changing. You could have two siblings that live together that support each other as much as any spouse would, but the government doesn't consider them spouses. And on the death of those single siblings, they would have to each pay, their estates would each have to pay the 50%. There's folks where their children are helping them, or maybe it's another family member who's helping them, and they want to be able to leave these assets to that beneficiary, but right now, of course, they can't. With the proviso that the proceeds must be paid out in taxable to that beneficiary of choice over a maximum of 10 years. So what we're saying is, rather than doing the cash out in year of death where you get that high taxation, can we spread the proceeds out over 10 years and then consequently the taxation over 10 years? We know that RSPs are a tax deferral mechanism. At some point, the government does want its taxes back, but is there a way to spread it out and lessen the tax burden in each year? But if that particular beneficiary does die within that 10-year period, then those remaining assets would be cashed out at in the year of death of that person. So we have gone forward to the government with recommendations, and hopefully they'll either take these into consideration or do a more in-depth analysis and maybe add to some of these recommendations. And in fact, we have seen that. And I don't know if you want to get into that now in terms of the response we've received from MPs, but we have had some somewhat positive feedback from some of these recommendations by the Finance Committee.
Before we get to that, I just have a further question about the RSP recommendation. So if you're proposing that it gets paid out over 10 years, is it that the beneficiary receives those funds and then they only are allowed to cash it out over a 10-year period at their tax bracket, or is it based on the deceased tax bracket?
Yeah, it would be at their tax bracket. And I know I bounced this off a friend of mine who's a lawyer and married, but the thing is, you may have beneficiaries who want it taxed to the estate because, let's say, the parent is in a much lower tax bracket, right? So I think it should be as an option,
So
an available option.
Either the parent, it's taxed in their hands, the lump sum.
The estate to the
estates of the lump sum, or they
that's what happens now, or you could have the beneficiary could have the option to select paying it out over a 10-year period
in their own tax bracket.
Yes.
Okay, I'm only asking that question because if it was being proposed that it was at the parents' tax bracket over 10 years, theoretically, that means the estate would be open and active for 10 years. And I don't think that's
No,
something
no,
that
no,
anybody
no,
would
we don't
want.
want
Okay.
that.
Okay. So basically, the beneficiary decides how they want to receive those funds.
Yeah, it's an option. And when I thought about payout annuities and their guaranteed periods, that tax is being spread out for the people who opt to buy a payout annuity. And there are people who choose to do that, even though interest rates are low, because they like the certainty. I want to know how much I'm going to get. I don't want to gamble with the money. So it's still an option that people select.
Okay. Yeah, I think that's reasonable.
And I was thinking too, with the term certain to 90 option, and I didn't know if banks could could sell those because there's no life contingency involved in calculating a term certain to 90. That would be a good option if someone developed a terminal disease and they know, I may be gone in 2 years. Buying a term certain to 90, say when you're 78, there could be 10 years of remaining guaranteed payments to the beneficiary.
Well, insurance companies do offer term certain annuities.
Yes.
So
Yeah, I
that is
thought
an
maybe
option.
banks could, no?
No, I think annuities are offered through the bank
Okay.
or the Insurance Act, and
Okay.
that's why it has to be offered through an insurance company. Where
Mhm.
I don't think they're allowable under the Bank Act, and that's the reason behind it. So potentially you'd have to change the act as well, and I don't think the insurance companies would be for that. They would fight that till no end.
No.
Right? But it's worth a try, right?
Sure. Yeah.
Well, this is about again education and discussion, and again, Elizabeth, hearing that like the financial well-being and impact for seniors of being able to take some of the recommendations that you guys are putting forth can have a huge impact, right?
Yes.
And as you said, a number of people that are single seniors are living below the poverty line, right? Which
Yes.
allows them some breathing room to make sure that they're able. I'm interested to hear from Denis, especially you being within the state side. But anything that you see as both feasible and potentially an opportunity for for a good outcome here?
Well, I think it really depends on the circumstances of every family. How many do you have any kids? If you don't have any kids, then it becomes very different. If you have kids, a lot of times you do want to leave it, and preferably in a different tax situation as opposed to after taxes. But I think we discussed a lot of the estate side when it comes to cashing in or being forced to cash in the RSP or the RIF. And the options there already. Now, other assets, we could talk about that, but I think in this case, you're really left with, you're really hitting a roadblock. And I'm glad there's some people asking for something different, because that is concerning a lot when you do have to cash in an RSP, especially if you die unexpectedly, where you just started taking out money out of the RSP or a RIF. That could be you could be hit really hard in that case. If you're long life in the family and there's no accidents or health scares or anything like that, then obviously you're going to take the full benefit of it. The government will get their money. See, part of the problem is the government wants their tax money, and that's why there's probably resistance on some of these recommendations. So all the best to you to get some of these passed. But there is, I could see why there is a hesitation on it. But it would be good for a lot of people if they could at least keep some of it intact for 10 years to the beneficiaries, especially if you're dying at that 65, 70 range and you still have kids that would need the money, all of it as opposed to part of it. That would be a good thing.
Yeah, I think there's some planning that we do. I mean, it's really a Band-Aid solution, but some of the planning that we suggest or recommend is if, for example, you have registered assets, $200,000, let's call it, and you know that at death, $100,000 is going to go to CRA. We recommend buying a life insurance policy to cover that tax bill, right? Because it gets paid out tax-free. So it is cheaper to have the insurance company pay that $100,000 bill than it is for the individual or the individual's estate to pay it, right? So it's not really a solution, but it is a bit of a Band-Aid solution right now. Changing the rules would be more beneficial for sure for a lot of people. But there are some kind of temporary solutions that are available right now. It just means that there's added cost to the individual. I mean, first of all, they have to qualify medically. That's no guarantee, right? There is a cost to support that insurance policy as well, and not everyone can. Um, so it's not a guaranteed Band-Aid solution, right? Because it won't apply for everyone who attempts that strategy, right? So
Yeah, I even tried that recently. I got an insurance quote,
yeah.
but it was very high at my age. And I just thought, I'll think of something else. It might
Yeah.
just be better to just take more out and pay the tax. And
Yeah, for sure.
I think
And you can also take a little bit more out, pay the tax to help support the insurance policy, and then the insurance policy can
yeah,
replenish it again if it's
sure. Yeah,
intended for a beneficiary, right?
yeah.
But those are some strategies. So let's talk about what has been the feedback, and then we're kind of getting near the end of our
Yes.
episode. But I don't want to leave that part out. So let's talk about the feedback so far.
Yeah, and as I said, we've spoken with 140 MPs across all parties, and we have received a fair amount of feedback. And I just want to emphasize, I think sometimes what you're hearing, even in the current election campaign, what you're hearing is, well, we're going to increase the guaranteed income supplement. Well, the folks that we're talking about here are not eligible for the guaranteed income supplement. So if we looked at our example at 50,000, for example, or if we even look at folks who are lower income, the GIS cutoff is around 22,000 for a single person. You know, we you can maybe bring up our another one of our charts there, Jim. But we've already showed that even at 30,000, a couple would pay no tax, and a single person might have to pay 1,700. Well, that single person at 30,000 is not eligible for the GIS, but they're still experiencing a major tax discrepancy. At 40,000, a single person, you know, might pay $4,000 in tax, and a couple may pay none. So, you know, I think the group that we represent, we need to be included as part of the national conversation from a finance perspective, when we're not. We're not eligible for GIS increases, so that doesn't really apply to us. If you look at some of the other things, we'll hear, well, you know, we're implementing the pharmacare plan and the dental care plan. Those are great plans, but they don't address the underlying causes of unfair taxation. Like, they don't talk about pension income splitting or tax credits. And in the example that I showed you about the folks at 50,000, the cutoff for free care is $70,000 in household income. Well, in the $50,000 example we showed you, a couple could sign up for dental, the single person could sign up for dental. That's great, they're getting dental care, but you still have a tax problem. So I think it's recognition that, you know, there's a lot of initiatives affecting seniors, and I'm not saying they're not good. But we also hear, well, you've got things like, you know, the disability tax credit, home accessibility tax credit, multi-generational tax credit, et cetera. Again, they're great. They're not targeted at seniors. They have nothing to do with marital status. All Canadians are eligible for all of those programs. We're not getting at the issue. So in terms of specific feedback, one of our recommendations was discussed by the Federal Finance Committee coming out of the 2023 budget period. And so they wrote a report called Responses to the Challenges of Our Time, and there's recommendation 115, which I will read. Examine the financial support measures available to seniors to ensure equitable treatment between single seniors and senior couples, including by considering the potential benefit of a non-refundable tax credit for single seniors and a higher threshold for the clawback of old age security benefits for single seniors. So our examples go a little, and recommendations go a bit farther, but the fact that that was included in a finance committee report means that representatives from 4 out of the major parties who sit on that committee talked about it and said, oh, this is a good thing. There wasn't anything similar in 2024, and we'll see what happens with the new government. In terms of things like pension income splitting, 2 years ago, we spoke with Aaron O'Toole, who was former leader of the Conservatives who implemented pension income splitting in 2007. And he said, oh, yes, we knew pension income splitting was unfair to single people. In fact, we came up with a few ideas to fix it, got them costed by the Parliamentary Budget Office, but the problem is they did not get reelected and form a government in 2015. So the Conservatives, while they were in power, knew there was a problem with pension income splitting as far as single seniors goes, but and they recommended solutions, but they didn't implement them while they were still in office. So I think they're aware there's a problem. We've heard things like there's no money to fix the problem of unfair taxation of single seniors. Well, pension income splitting and the extra credits that couples get, that is a cost to the government. Now, again, we're not advising that the government touch those, but I'm saying is there is clearly money to be spent on married and common law. What we're asking is that additional monies are found to compensate and make taxation fairer for widowed, separated, divorced, and never married, especially as we've already discussed. We can't really find any differences as to why there are even discrepancies in the first place. We've heard that we talked about earlier that the prevailing view or common view amongst MPs is that couples money needs to pay for two people. Well, we've already discussed at length that there's no factual basis for that perception. And again, we can't be basing taxation policy on perception. It should be based on facts, data, and reality. Another MP said, make me the argument about food. We talked about that earlier, food being like one example of one data point and things that households spend money on, but it's not part of a collective view of what are all the things that seniors spend money on. There's a lot of emphasis, of course, in the government on youth and generational fairness. And the government talked about in their last budget, how do you, they actually called it, I think, fairness across generations. And so what MP asked us, how do we explain to young people that we want to spend more money on seniors? And our group is not saying that we don't want to pay tax. We're saying we want to be taxed fairly. So to go from a position where we're paying more money on the same income as couples to paying similar taxes on the same income as couples. So, so I think we are going to continue to work with the new government, new MPs. We're planning on sending out a communications once, of course, the MPs are elected and we know their contact information to say, hey, we're here and we're going to just keep advocating and using venues like this to, spread the word and maybe hopefully MPs will be listening to this podcast and get a greater understanding of the issue. But I think MPs still have some perception problems and data problems that they need to sort through.
Well,
And a
I
lot of
think
the
a lot.
taxation.
Sorry, I was just gonna say I think a lot of MPs and government people could learn a lot from listening to our podcast. So
Oh yeah, I would agree. I'm more than happy to spread the word.
Because a lot of the taxation, when you talk about RSPs were introduced in the late 50s, that was leave it to Beaver, father knows best time,
Yeah.
where most women did not have a paid employment outside the house. Families were bigger and you could afford to keep buy a house on one income. Society has changed markedly. And
Yes.
originally, this rollover, they were married men and women, legally married. Later, they threw in common law, and now it's you can have same or opposite gender. So society has changed, but the Income Tax Act has not kept up with it.
Right.
Yeah, I mean, one way they can help the younger generation in buying
Yes.
homes is, maybe if they accept it, the RSP at death, they use it towards purchasing a home,
Mm-hmm.
right? Then it's non-taxable, right?
Yeah.
It'll help the younger generation to get into homes, and it could be either child or grandchild, right?
And as we said, so many seniors are already doing this, or they're having children, either the couples or single seniors are having children move back in because they can't afford a house or they've been rent-evicted or maybe even going through marital breakups again, the things in our society that we weren't dealing with towards the end of the last century, right? So again, I think comes back to the earlier point that as Canada has changed and society has changed, our tax policies and RSP policies need to keep up with it.
All right, I think we're going to have to start winding this down because we're approaching the 1 hour mark.
Yep.
So what I will say is this, is absolutely take a look at the website, I don't have everything in front of me here. I've got too many windows open up.
Singleseniors4taxfairness.com.
There you go. Thank you very much. In terms of this recording, we're going to be sending it out in various formats. So there will be the YouTube version of this. So if you like video, a wonderful place to consume this information. We are going to be launching it on our podcast, and it'll be available on all the podcast platforms. So Apple Podcast, Spotify, you name it, it'll be out there. And we're also going to generate a blog post as well. So for people who like to read, we will have a blog post. Typically that gets sent out on Friday. So if you're looking for access to any of this information on our website, you can access the information at www.tvhfinancial.ca, or you can go to tvhgroup.ca, and you will see the blog post. And in the blog post will also be a link to the video. Ryan, how else can they find this information?
Well, you just said it. tvhfinancial.ca. I did not memorize the phone number. As always, I leave that to you because I don't call myself or ourselves. So.
But we have social media, right? So how can they find us on social media?
Instagram, LinkedIn, Facebook, TikTok. Still haven't started doing videos. I'm still waiting for Denis to do his video. But there's many ways. And again, a final thought, like obviously as a younger person, like, you know, this is our generational wealth. If you don't realize this yet, the government's going to take more than half of what your family, when one of your parents becomes single, allow them at the same time to hold their wealth longer and be able to support themselves. Because again, the cycle is, I guess the scare is your parents are going to move in with you when you're older, or let's help them get a tax break now to make sure that they're able to work, to live on their own, and that you can continue to visit more and more often, and make sure you call your mom. So sorry.
Well, listen, I'd like to thank everybody for their time. I think this is a great topic, and we're going to spread the word as best as we possibly can as well.
Absolutely.
And if, you know, at some point, if you get some traction, we'd love to have you back on a follow-up episode as well, if you're okay with that. Perfect. But yeah, we appreciate your time, and everyone. I mean, it is election night or day, right? So in a few hours, we're going to find out who's going to be running the country for the next 4 years. So exciting times. Anyways, thanks everyone. Take care.
Thank you. Bye.
All right.